This is not a regular update. As I record this, it is the fourth day of an active military conflict between the United States, Israel, and Iran. Indian markets are closed for Holi, and the single most important shipping corridor for India's energy security, yes, the Strait of Hormuz, is effectively shut down. Now, I am not here to give you the news bulletin. You can get it from anywhere, and news channels are bombarded with that. I am here because you trust us with your wealth, and you deserve to know exactly what this means, what we think about it, about your money, and exactly what you should be doing about it. Let me be very direct. The next 7 to 10 days will determine whether this is contained disruption or something that is actually fundamentally altering the investment landscape altogether for the rest of this year. So let me walk you through what has actually changed, why India is more exposed than most people realize, and most importantly, what you should and should not do when the markets reopen. Let me cut through the noise and tell you one thing that matters more than anything else in this crisis. It is not the bombing campaigns. It is not the casualty that figures. It is not the political rhetoric. It is the Strait of Hormuz, the one single determinate element that will be impacting your portfolio. Roughly one-fifth of world's traded oil, that is 20%, passes through this narrow channel every single day. And as this morning, tanker traffic has dropped to effectively zero. Major shipping lines have suspended all transits. Insurance underwriters have pulled coverage. Three tankers have already been struck. Now, this is not a theoretical risk. This is an operational shutdown. Now, why you should care about a waterway thousands of kilometers away? Because India imports 88% of the crude oil. And more than half of that, yes, more than half comes all directly through the Strait of Hormuz. We are also dependent on this corridor for roughly 85% of our LPG imports. So when somebody tells you that this is a Middle East problem, understand this is an Indian problem, not a Middle East problem for that matter, as far as the portfolio is concerned. Now, this is an inflation problem. This is a rupee problem. If this persists, this becomes a portfolio problem. Now, this brings us to the section 3 of this video. That is the transmission mechanism, how oil flows into your portfolio. Let me explain exactly how rising crude prices transmit into your wealth. First, the current account. Every $10 increase in the Brent crude adds roughly 0.4% to India's current account deficit. At current prices, we are already looking at an additional $15 to $20 billion in annual import costs compared to the pre-crisis level. Now, that money has to come from somewhere. It comes from the rupee. It comes from reserves. It comes from you and me. So the second point is inflation. The same $10 move adds roughly third, yes, 33% of to the wholesale inflation. And it does not stop at the petrol pumps. It cascades. Transport costs rise, input costs for FMCG, paints, fertilizers, all go up. Margins compress across the board. Third factor, the rupee. We have already seen the rupee weakening in the past and also passing through 91.50. Now, a wider current account deficit combined with capital outflows puts sustained pressure on the currency. The RBI will intervene, but there are limits to which RBI can intervene. Now, the fourth factor being, now this is what the most people actually miss, the monetary policy. If oil stays elevated, the rate cut that markets were pricing in could be pushed back entirely. The bond yields are already rising. This changes the calculus for the debt portfolios or the fixed income portfolios, real estate financing, and also leveraged positions. So you see, this is not just about oil, one variable or a crude price. That is your that would touch your current account or your inflation or your currency, your interest rate environment, and therefore every single asset class you hold. So with this, we now enter into our section 4, that is what you must not do. Because at moments like this, the biggest risk to our wealth is not the crisis, it is our reaction to these crises. Point number 1, do not panic sell. when the markets reopen, the expected gap down is already reflected in the GIFT Nifty pricing. If you sell into the gap down, you are not managing risk, you are transferring your wealth to institutional buyers who are waiting patiently on the side of your order. Yes, if you are selling, there is somebody else there to buy it out, and the institutions come there first. Point number two, do not redeem your SIPs or your long-term equity positions. We have shared this data before, and it bears repeating. Every major geopolitical crisis in the last 35 years, Gulf War, 9/11, Iraq, Ukraine, was followed by a full market recovery within 31 to 97 days. Now, every single one. The investors who sold during the panic underperformed those who stayed disciplined. Point number three, do not deploy large fresh capital into equities right now. If you have fresh one, if you are reallocating it, that still holds good. Now, there is no clarity yet how long the strait remains closed. Putting large sums into work before that clarity emerges is not a conviction, it is a speculation. Point number four, do not chase gold at the all-time high with the lump sum purchases. You can stagger. Gold has already been pricing in the significant crisis premium. If you want to add gold, do it in tranches through different assets. While SGB are no longer there, but gold ETFs or some gold mutual funds can be done. Point number five, and I cannot stress this enough, do not act on WhatsApp forwards or a social media speculation. In a crisis, misinformation spreads faster than the facts. Stick to the verified sources, stick to your advisor, and then you need to have a solid backing of data to support your actions or not to support your actions. So section number five, what you should be doing right now. The holy break is in a sense a gift. The markets are closed, you have time, use it. First, review your asset allocation. If your equity exposure has drifted more than 5% above your target, this is a pause or right time to plan a disciplined rebalancing, not a reactive fire sale, but a strategic readjustment you execute with clarity on Wednesday or a Thursday will be a good step. Point number two, assess your gold allocation. If precious metals are below 10 to 15% of your portfolio, this crisis is validating exactly why gold belongs in every serious portfolio, not as a trade, but as a structural protection. Point number three, and this is what separates disciplined investors from the reactive ones. Build your deployment watch list now. Identify 5 to 10 businesses you have always wanted to own at better prices. When clarity emerges, you want to act within hours, not spend days deliberating. Now, point number four, understand the oil prices thresholds. Brent between 75 and 85 is manageable for India. 85 to 90 becomes concerning. Above 90 or 100, where we are looking at the entirely portfolio restructuring. Now, we are monitoring these levels in real time, and we will alert you the moment thresholds are reached. Now, the point number fifth, evaluate your sector exposure. Aviation, paints, logistics, FMCG. These are the sectors facing immediate margin pressure from the elevated crude. On the other side, upstream oil producers likely, and also the defense are likely to be beneficiaries. Know where you stand. Point number six, for those of you with cross-border exposure, NRI remittance flows, rupee hedging positions, India-focused fund allocations, all of these need to be reviewed in light of the weaker rupee and elevated volatility. Reach out to us for guidance and specific inputs. Now, the broader perspective. Yes, section 6, the broader perspective. Now, let me give you the context that matters. India holds approximately 100 million barrels in combined strategic and commercial petroleum reserves. That is roughly 40 to 45 days of coverage at the current import levels. Alternative supply routes via Cape of Good Hope, while adding 2 weeks of transit time, remain fully operational. OPEC Plus has signaled willingness to increase output, and the Indian government has already convened a cabinet committee on the security meeting to address the crude supply, shipping safety, and welfare of 9 million Indians in West Asia. Now, this is serious, but it is not unmanageable. It can still be managed. Now, what makes it more dangerous is not an event itself. It is the compounding of the poor decisions made in the fear. We are here to prevent you from that. Now, section number 7, that provides a summation of what we are talking about. I will leave you with this. In 35 years of market history, there has not been a single geopolitical crisis that has not eventually become a buying opportunity. Not even one. The pattern is consistent. Panic creates opportunities. The investors who act on the fear underperform. Those who on data actually perform. Your job this week is not to predict what happens next in the Middle East. Your job is to make sure your portfolio is positioned to withstand the worst case and capitalize on the best case scenario. Now, this is what serious wealth management looks like. We are monitoring the situation around the clock and we will issue an updated advisory or our inputs on the same before the markets open on Wednesday, if the situation warrants. Now, and our lines are still open throughout the holiday. If you want a personalized portfolio review, call us. We are all here. Stay informed, stay disciplined, and we will get through this together.